Real stories, expert insights, smarter decisions.
If you want to get in, you can do it, do it. Because rates are all based on risk, right? So what you find is the lower the interest rate, usually the more questions they're going to ask you. And my question to everyone out there is, would you pay an extra $5,000 a year knowing that you could acquire this asset? And you know behind the scenes that's going to grow. Land is king in my opinion. I got a client who bought 3 years ago for 1,000 square meter block for around 1.4 mil. Today, 3 years later, it got valued at 2.5. I fight for my client. I fight for the deal when I'm confident that, mate, you shouldn't even be questioning this deal. You should just give it the green light because it was so good.
Yeah. Tune in and find out.
G'day everyone and welcome to episode 3 of Inside Residential Property. My name is Liam Garman and I'm the co-host of this amazing series. And today we are unpacking a very important theme that I know a lot of our listeners right across the country are very excited to learn more about, because it's something that it does impact portfolio growth over the long term, and that is everything serviceability and everything broking. And today I'm joined by a very special expert guest who's been instrumental in helping Australian investors unlock smarter and more strategic pathways into property wealth. And I'm joined by, of course, Son Pham, Director of Rethink Financing and Senior Mortgage Broker. Son, welcome to the podcast. How are you going?
Good. How are you? Thank you for having me.
And you do have a lot of accolades that come with you. You were you're awarded Commercial Broker of the Year recently at the 2025 Australian Broking Awards, and it's a fantastic pedigree that you've got in helping people build their portfolio so they can unlock financial success going into the future. And we are joined by someone who will be joining us in just a second to unpack their portfolio. But Son, talk to us a little bit about yourself, a little bit about your background in the world of mortgage broking.
Sure. So, I've been doing this for some time now, probably call it about over 10 years. But really, I'd say probably the last 7 is probably where I've really started to really dive into mortgages. I'm an ex-financial planner. I've been in the wealth management game for over 15 years. Worked for the banks, private practice, then my own business. So over the years, I've learned all about strategy, structures, tax, and then most recently, all these things, lending. So being more of an expert in terms of commercial, but to be commercial, you have to know a lot about residential as well. So residential is the pathway to commercial. But yeah, I've got many years of experience. I've seen a lot. I've seen some really interesting things, but I can definitely help our listeners, our borrowers out there borrow more money. We get it very common. People come through and say, hey, I can't borrow anymore, but I've got plenty of equity. What can I do? So we hear that a lot, but we can definitely help if we use the right lenders, right policy, right structure, we can get further lending.
And I think, I see it all the time with investors that I speak to right across Australia that we are at this point where serviceability is becoming a challenge for a lot of people. The lending environment's changing all the time. I think it's become top of mind to a lot of investors that they do need to see their broker as more than just someone that, speaks to the banks on their behalf. They are at the core, it's a strategic advisor.
100%.
You're helping them on their journey for portfolio growth, because you need to rely on your broker for things like bank policies. And when you're structuring your portfolio and looking to scale, making sure that your bank policies are complementary over the long run is critically important. And it goes further than just looking for the lowest interest rates. 100%. And that's where a lot of Australians, a lot of investors really get stuck, because they fight for the lowest interest rates and they suddenly realize that they can't get that extra property. And also in terms of investing strategy, getting your broker's insights into, well, if I buy X property, what does my next property look like? We do have an amazing guest who will be joining us virtually. I am introducing Danny Denver, who is online joining us via Zoom. Danny, welcome to the podcast. And just quickly, can you give a bit of a snapshot into your portfolio at the moment?
Sure. G'day, Liam and Son. Thanks for having me on.
Hey, Danny.
So in 2013, my wife and I, we built our home in Glenmore Park, Western Sydney. And over the years, it grew in value. And by 2017, we decided to tap in for that equity and start investing in property. At the time, we didn't know much. We sort of went off the lived assumption that property tends to grow in value, and the more we could own, the better off we could be. So with no mortgage broker, accountant or buyer's agent. We made a typical rookie move and bought something shiny and new in our own neighbourhood, just 150 metres from where we live. After that purchase, I decided to get better educated and start reading books and listening to podcasts like this one and listening to and learning about other people's journeys. And by early 2018, we were ready for our next investment. So this time around, we worked with a mortgage broker, an accountant, and although we hired a buyer's agent, we ended up sourcing the property ourselves in Raceview, Ipswich, Queensland, which had a Defence Housing Australia lease attached to it that ran until 2022. So today, both properties have grown in value, both yield pretty well, but the Ipswich property has definitely been the stronger performer overall. We've also made a few moves into the commercial space, but we're now looking to shift our focus back to residential if we can sort out this finance. What I've learned with finance along the way is there's normally challenges that comes down to two things. It's a lack of capital or equity, number one, and number two is a lack or a perceived lack from the bank in regards to serviceability. And right now, our biggest hurdle is serviceability.
I think this is a pretty common insights from Australians as they start their property journey. And I think, Danny, you might have been a little bit more hard on yourself because you have done the right things, which is, you will have podcasts to say, go out and do the rent vesting thing, but you got educated, you realize that you need to be surrounded by that A team, which includes the broker, which includes the accountant, speaking to people like buyer's agents, and even though you've gone out and sourced it yourself, to make sure that you're making informed decisions going into the future. Throughout this journey, what's been your underlying philosophy that's kind of prompted your purchasing decisions?
I think after 8 years of investing now, it's pretty safe to say our purpose is much clearer than when it was when we started. Our mantra is simple. Time is really the true currency, not money, and that's what really drives us. So my wife and I, our goal is to have working be optional by the time we turn 50, which is just over a decade away. And we want to get there without taking excessive risk or being too restricted by negative cash flow. So I want to sleep at night well, and I don't want to live off 2-minute noodles. So I'm optimistic we'll get there, but I know that the goalposts can change along the way, and that's okay. And I guess along the journey, a few mottos have helped shape how we invest today. And I think the top one for me is action beats perfection. So taking action is crucial. You can get educated, you can have all the knowledge, but if you don't act, then it's useless. Another motto is debt is a tool, not a threat. Mm-hmm. We used to be very afraid of debt, and but property is a game of finance and leverage, and you have to really take that courage over comfort. Mm-hmm. Some other ones are cash flow fluctuates, but growth compounds. So sometimes we face and accept short-term pain, and we strive for that longer-term gain, and that sort of holds us true and keeps us steady. And lastly, property investing is not passive. It takes effort, organisation, problem solving. But look, so far, from where we sit, the juice has been worth the squeeze.
I think those are fantastic insights, and I totally agree with why debt's a positive thing. My wife and I have gone on that journey ourselves when we used to get pre-approval, and you'd see how much debt you're racking up. It'd make you sick at the beginning of your journey. You're like, if the market tumbles, I'm gonna be owing all this money. But now when I get pre-approval, I'm really excited for more and more and more, because that's unlocking your ability to scale. Now I'm going to hand over to Son to speak with Danny, unpack the ins and outs of the portfolio. Danny, it's probably the hard part of the podcast because we're exposing all, but I'll hand over to Son.
Yeah, so what Danny's going through is very common for everyday Australians, right? They've got some property, they've got plenty of equity, but they're hitting a servicing wall. So a lot of people always like to chase rate, which is the worst thing to do, because not all lenders are made equal. It's all about policy. And when I talk about policy, I'm talking things like, if you've got an income, right, base salary, every lender will take 100% of it. Then if you've got overtime, bonus, allowance, lenders will take 80% of it. But then there are some lenders that will take 100% of it. Then you've got things like the assessment buffer, 3% on top. So if your interest rate is 6%, they'll assess you at 9%. Now, obviously, yeah, the lower the interest rate, that will help, but that will never help as much as, say, you've got a lender that might only use a 2% assessment or a 1% assessment. I've got a lender that will even do actuals. All right, it's a real sneaky one that they've got, but there's a trick behind that one. But essentially, you've got to look for these policies, right? And as a mortgage broker, we know all these policies because we deal with so many lenders. The everyday Australian doesn't have the time to do that. And it's very common for them to just go to the bank directly because they see the interest rate is much lower. I'll go apply, and then they get shot down and they're like, oh, well, I can't borrow. And they think that's the end of it, right? But it actually isn't. So for Danny's case, I guess my job would be to understand his income position. He spoke about it before. It's very simple. There's two things you need. Income is one, right? Whether that's your income from employment or your rental income as well. But then your expenses, which means loans, living expense, all that together with buffers and shading. Is there surplus income left over? If there is, great, we can borrow. Now, the surplus that's left over is all subjective depending on the lender you choose, right? So if you go into a major bank, for example, or a bank in general, 3% assessment, 80% shading on incomes, etc., you'll find that surplus at the end is very small. And then they'll go, I can only lend you $300,000 for this next property. But if I take you to, let's say, a non-bank, uses 2%, 1%, whatever, existing debt at actuals, there's all these little things we dance around, then that surplus on paper looks like this. And the lender will, well, I can lend you 600,000, 700,000. It comes with a little bit of a slight higher interest rate because rates are all based on risk, right? So what you find is the lower the interest rate, usually the more questions they're going to ask you, right? And the harder it is to get that loan. And so what we tell our borrowers out there is, look, don't worry about the interest rate. Let's look at leveraging, right, and buying this next property. It might cost you an extra 0.5%. Now, just to give the viewers, the listeners, some context, right? If we were to get Danny another $1 million, all right, and the interest rate is 6% normally, but I'm getting him 6.5%, that's an extra 0.5. So on $1 million, it's $5,000 in terms of interest. Okay, now that part of that is tax deductible, depending on your marginal rate of tax, and so you get a bit of that back. So there's a little bit more hurt, obviously, because it's higher interest rate, but it's not that much. And my question to everyone out there is, would you pay an extra $5,000 a year, knowing that you could acquire this asset, and you know behind the scenes that's going to grow in value, and I think it's going to grow by more than $5,000, right? It's a no-brainer in my opinion. You know, the market lately has moved a lot. One of my brokers, we talk about deals all the time in the office, and we saw one recently where the client had bought a property 6 months ago for $650. We valued it today at $800. Yeah. It went up $150,000 in 6 months. So in my opinion, mate, I'm paying that extra 0.5%. I'll pay even 1% higher because I know that's going to happen, right? And then we could always refinance it back in time to a lower interest rate with these other policies that lenders have, right? So with Danny's situation, yeah, I'd be sussing out what's your income, what's your rents, what's your total debt position. Can I service it traditional sense? I don't think I can because I think Danny's already tried that, right? So then I'll be like, actually, Dan, who's your current lender?
For all the properties.
For your loans currently? Yeah, all your mortgages?
We use Bank West for a portion of the investments, and then we've got a combination with Adelaide Bank, Think Tank, and ANZ. Yeah.
So there's already a non-bank in there. So that usually tells me that, if we're using non-banks or non-traditional lending, it's because serviceability is tight, right? You've got things like putting it in an entity like a trust. I'm sure everyone knows about it or heard about it by now, but Macquarie Bank came out recently where they've closed that loophole.
For trust lending?
For trust lending. Yep. But, that was because Macquarie had a very silly loophole. They have a policy that says if you've got anything in trust or we're not taking that income to account, we'll ignore it. And a lot of lenders will do the same. But there was an infinite loop because for them, if you had a loan with them in that trust, they would still ignore it because that first policy says we'll ignore it. But most other lenders go, no, if that loan's with us, even though it's in a trust, we will still expense it and look at it. So they just closed that loophole. NAB's kind of closed it as well recently. I think it's just in light of how fast markets are moving. They just want to slow it down a little bit, but it doesn't mean you still can't do it. We just got to go elsewhere. There are hundreds of lenders out there with different policies. We just got to find the right one to fit your situation. So for us, mortgages, lending, it's a constant change. 1 minute you're using this lender because of one policy and they close it, and then someone else opens it up to be competitive. They want market share, they'll take something, then you just go there. You know, and at the end of the day, we do what we can to help people like Danny to just, you know, get that extra. So, you know, I got one non-bank at the moment. He'll do 1% assessment, everything else at actuals that he's got. Can even go to 90% with no LMI. You know, it's like an offer at the moment. It's insane.
Yeah, that's good.
You know, the rate is high though. You're talking maybe like 7.5%.
Yeah.
That's almost like 2% compared to where the market is.
Yeah.
But if you're an investor, you don't care about that because you know that I'm going to buy this asset. Like I said in that example, it's going to grow in value. And then after 12 to 18 months, we refinance it back under a 1% servicing policy, right? And then next thing you know, you're back on. Great rates, cash flows there, equity, and just keep doing that.
And that's the point, highlighting the interest rate point. And, you know, not to labour it too much, but you gave the example of 1 million. When you're looking to buy in the outer urban areas or the regional areas, we're not looking at $1 million loans. We're looking at even $500,000 can be quite 100%. High for some of these areas, which then brings it down to $2,500. That's less than $250 a month.
Yeah.
Realistically, that is disposable income that people can tighten their belts a little bit, and it does become a rounding error over 12 months.
It's mindset, definitely mindset. You know, when they see 5.5 versus 6, they go, oh man, that's like so high. But then if you look at the actual numbers, it doesn't actually translate to be that much. But it's that mindset, just like Danny said before. You know, the word debt, that's ugly. You think of that as like, oh, it's a burden. It's, you know, ball and chains, and, you know, it pulls you back, right? But when you use the word leverage means, you know, position of power type thing where, you know, you're using that to get to the next piece, right? So it's all about shifting the mindset.
Now I'm going to invite Danny and yourself, Son, to go through some of the numbers of your portfolio so we can make a bit of an assessment as to where Danny can go from here. Danny, do you want to take us through your Glenmore property and where that's at the moment?
Sure. That's our first investment. So as I said earlier, brand new 4-bedroom townhouse in Glenmore Park. We bought that for $680,000 and originally rented for $600 per week. It's now worth just over $1 million and rents for $770 a week, which represents about 5.9% gross yield on the purchase price. So when you factor in the purchasing costs, the equity that we released, we effectively borrowed, I think it was 107% of the purchase price. And so at today's interest rates, it's slightly cash flow negative, about $120 per week pre-tax, but the depreciation benefits definitely help offset that.
Definitely, yeah.
And then you pivoted to Raceview, which I understand is outside of Ipswich. What prompted the move into the Brisbane market?
Yeah, well, by this time, I'm more educated and more informed. So realised that I had access to property markets across all with their own cycles, drivers and opportunities. So the play here was to find something affordable with growth potential and a healthy rental yield as well. Our borrowing power was lower than the first purchase, so we did focus on value. So we ended up buying a 4-bedroom house in Raceview for $335,000. It was leased to DHA at $350 per week at the time. That lease has since ended and it now rents for $600 a week, which is a gross yield of 9.3%. And the current property value for this one is $820,000. It is cash flow positive, only slightly at $20 per week pre-tax. So yeah, that's our strong performer.
Nice.
So unpacking where Danny's position is at the moment in terms of serviceability, pretty much realistically kind of cash flow neutral. How does he look from a serviceability perspective? Where are his next steps in terms of growth from here?
Yeah, so I'd have to ask Danny about his income, his wife's income, what the living expenses are, any other debts like credit cards, car loans, help debt. I won't ask him here. A bit private. But yeah, so the good thing is Tick has already got the equity position, right? And I know that he's recently refinanced and he couldn't get any equity out, right? So I know I can get something for him.
So can I ask why is that? Because it seems like both assets have grown quite substantially. What is it stopping the banks from allowing him to take equity out?
It's purely just lending policy, so serviceability. So the income shaded minus tax, living expenses, all the existing loans he's got at the 3% buffer. They chuck it all in a calculator. When you work it out, it'll say that the surplus left over isn't a lot, and we can't lend you that extra money per se, right? But I know, off the top of my head, if I can go to these non-banks or a lender with a really good policy, use actuals or 1% buffers, I can get him increased serviceability, right? Using things like the trust structure as an example as well. So if he bought the next one and in time, if that was positive, like his current Raceview one, we can then go to a lender and just go, here's the accountant's letter. This is looking after itself. We don't need to actually put any money into it. They can then just forget about it, right? Now, in reality, it's not costing him anything, right? So why can't we lend him any money? The reason that, again, is it's just policy. So, you might be getting the 30,000 in rent, but they shade it down. They go, we'll only take 22. Your loan repayments are at 20, so it is neutral. But we're going to assess that 3% on top.
With a buffer.
With a buffer. And so now it's like your payments actually look like they're 30,000. So there's less money coming in than money going out. So, but that's just lender criteria. But in reality, it is neutral / positive, right? So I'd be looking at, non-bank sort of lender, different policy, and probably looking at maybe some trust structures moving forward. Or just another entity. Doesn't have to be a trust per se, not giving taxation advice here. But, something like that to in the future, because these assets over time will become positive. You've got rental increases. If you keep the loan where it is, right, you will find that over time. Look at Race for example. It started off at 330 or something it was, can't remember. But now it's, doubled, right? So that in time, these residential properties will become positively geared in its own right. So it won't be positive after we take money out of it, but, it's to get the next one and the next one and the next one. And then fast forward 10, 15 years, you get asset appreciation. We keep the loans where they are, interest only. And then in time, if Danny wants to offload, he can offload one property, let's say. There's so much equity that can pay off 2 or 3 properties. And then they'll get closer to meeting their cash target, the cash flow target.
Danny, when you were giving a brief insight into your portfolio, you mentioned that you dabbled a little bit in commercial. Now, we didn't focus on that because you said you redirected back into the resi world. What was some of your commercial moves? What did they look like?
Yes, I've got 3 commercial properties. I've got a property that's at a retail industrial up at Paget, which is near Mackay in North Queensland. I've got a office on the fringes of East Perth, and I have a medical facility in Maroochydore, Sunshine Coast, Queensland. So, it makes up over half of my portfolio, and with all of that combined, we're sort of notching close to 6 million worth of property in the portfolio.
So that would presumably add into the serviceability aspect of that as well. Now, a lot of our listeners who would be dialing into this, who might be at that, say, 2-3 property cap because they've gone into the blue chip suburb, they've over-leveraged themselves, they find they can't move on anymore, might rush into an investment. This is something that is very common, and people do get the idea of trust because they listen to this podcast. However, there is a risk of moving into trusts too soon. Not knowing Danny's ins and outs of portfolio, obviously between Danny and his accountant, whether he's in a position to move to a trust. However, there are a lot of people that are out there that do move to trusts too soon. And when we speak to BAs and mortgage brokers here, we hear it all the time that they get new clients coming through that move to trusts way too early, and they forfeit a lot of that negative gearing benefits and that they could have had otherwise. Son, when do people know? What are those markers that they're ready for a trust, and what's a marker that it's too early to move into a trust?
Ooh, good question. I know this is a residential podcast, but I'll just quickly touch on the commercial side. The reason why for us we do a lot of things in a trust / a company for a commercial is because of this really U-Butte product called a lease stock, okay, where we can ignore all their personal lending, etc. Right? So, that's one of the main reasons why we do that from a lending perspective. Again, I'm not a accountant here, so I'm not going to give you taxation advice, etc. But with residential, when is the right time to go into a trust? I'd say speak to your accountant. A lot of accountants want to utilize, the negative gearing per se, because then you can claim that deduction immediately. So, personal lending, I would keep going as far as you can until you get that serviceability wall, right? Buying in different states will also help alleviate the land tax position as well. Because if you bought all of them in, say, New South Wales, thresholds, etc., and then next thing you know, you're paying land tax in the individual name. So usually, when you get to that buffer, right, it just depends on your personal situation. Okay, so you could be 6 properties in the individual name, it could be 3. It just depends on where you bought, what your thresholds are, and what your accountant advises you. But from a lending perspective, I'd say the time to go into a trust is when you're hitting these serviceability walls. So I'd say for this one, for Danny, if I could extract the equity in his personal name, great. Let's buy the next one, in an entity, in a trust company, whatever it may be. Because then technically, if we could ignore that trust moving forward, right, he's okay with all his individual stuff if he needs to move around, take out equity, refinance, whatever it may be. So that's what I would say is where we need to be. Now, even though you don't get the tax deduction immediately, the trust gets that tax deduction, right? So it is being claimed somewhere, which in time you can, offset capital gain, whatever. Again, go speak to your accountant. No tax advice here. But there is deduction still, right? It's just not claimed at the individual level. But that's probably what I'd do.
Now, I'd love to get some insights with all of this as a background and as a good starting point. We've been unpacking Danny's particulars for about 20 minutes now, so I'm sorry we've been showcasing it all to our listeners. But Danny, with this as a background, can you share some insights into what your goals are and what you're looking to achieve from property investing going forward?
Sure. So we've had a look at this together, my wife and I, and to maintain our current lifestyle, we'll need around 150K per year in pre-tax investment income, and that's without a mortgage for our principal place of residence. And like for an amplified lifestyle, let's add a few extra bells and whistles, then the target becomes 200K. And I think to achieve this, we do need to keep accumulating. And so my questions are, how can we get finance ready to purchase our next investment up to a certain amount? Based on our goal and current portfolio, how do we know if and when to sell to advance our position? And how can we simply spend less time on the sideline while we're in this accumulation phase due to the serviceability and the borrowing limitations that we're facing right now?
Over to you, expert.
All right. So, definitely got to keep going, keep buying. So do what you can in terms of borrowing to purchase the next one, because we know at the end of the day it is about the growth. The rents in time will help cover the portfolio. It does take time for it to grow, like example, raise through 300, 600. So I guess my job / role is to help Danny just borrow and leverage and buy the next asset. Because in time, he can always look to sell, right? Now the question is, there is a theoretical limit that we will hit, right? Assuming that nothing changes for Danny, right? But, if his income increases over time, rents increase, sure, our serviceability line keeps moving, okay? But if we assume that it doesn't move anymore, right, we will hit this theoretical limit, right? And then he will have to look at offloading, right? Now, the question is, which one do we offload? Okay, can't give you financial advice, but what I would do personally is look at those assets that's probably not performing, right? Or look at one that maybe has performed and has created enough equity and you just don't think it can go anymore. I got a lot of clients who've bought apartments as an example. Apartments don't grow as fast as, say, house and land, but it has grown, okay? I'd always say, offload maybe something like that, because getting into house and land can be worth a lot more in the future because of the development aspect. The improvements is what we call it, rezoning. You might have a house, but then all of a sudden you could build a duplex on it, right? So I'd be looking at underperforming assets or an asset that's maybe also performed, but maybe it's time to, reap those benefits, pay down some of the debt and buy another asset, or just buy another asset with those funds. Working closely with the accountant as well to make sure all your taxation is right, keeping all those tax deductions high. But yeah, bit of mixture of everything, right? We just got to monitor. Hopefully every year there's an increase in rents, increase in salary, interest rates. We can get better interest rates if we can. But if we need to leverage, can't do that. Utilizing structures as well. And then in time, look to offload.
So a lot of it does come down to the basics, the fundamentals of opportunity cost. That you don't necessarily have to hold on to an asset. Say it's performed very well, but the market's losing steam, and you did an appraisal a year ago and you appraise it now and it's not really moved anywhere. You're looking at the market, you're looking at comparables, it's not really moving anywhere. You could perhaps say that it's done its job, and you don't necessarily have to hold on to it, and you can part with it having done its job, which would then allow Danny to free up that serviceability, to free up that lending with one of his stated goals, to spend less time on the sidelines, to then move into the next purchase.
Yeah. So I guess on that front, we don't like to sell anything if we don't have to, but there might be a time where, like you said, you've had it for a year or 2 or 3 years and you feel like that's enough, hasn't moved anymore. I always say, look, and some people will say, oh, it's the worst time to sell. Market's down, whatever. It goes both ways. If the market's down and you sell, okay, you're not getting top dollar for it. But as long as you get back into the market at the same time, so you sell low, you buy low, right? Or if you're selling high and you're getting back into the market, you're selling high, getting back in it high. So as long as you pivot and you get back into it, no problem. But I guess if you take it and then you sit on the sidelines for too long, you've potentially, lost out on that market opportunity. So, if I was to give advice to Danny, if it is time to sell, we'd look at what can we sell, but then when we get those proceeds, what are we doing with it? Let's get into another asset straight away, right? So we don't lose that time.
Given that he's got 2 assets that are performing at maybe different trajectories, is a fair way of putting it. Should he or someone in his position, I think it's probably quite a common position to find himself in. And I do apologise because I think earlier in the podcast, Sandy, I said that Glenmore Park was the PPOR, but it's the first investment. Probably quite a common piece that a lot of people find themselves in, which is they buy an investment property local to them that doesn't necessarily perform as well as, looking at Perth over the last 36 months, right, where you've got house prices that have just tripled. Everyone does that realistically when you start your journey. So you have a portfolio that's moving at different trajectories. Should someone in Danny's position be prioritizing capital growth or cash returns, the yield? Where should he be looking to put more thought and stock into?
I guess Danny's got income, right? Most investment when they start out, commercial as an example, is not where to go because it needs a lot of deposit, a lot of capital. But getting to resi is less capital intensive. But I guess the net return in terms of income isn't as high as, say, commercial asset. But, definitely I prioritize growth whilst you're young, because that growth, you can use that for something else. It doesn't have to be property, it could be anything, right? That growth, you sell it, you've got whatever it is, the growth to go into the next thing. So as an example, just looking at those 2 assets he's got, he bought the townhouse, I think it was 700 odd, and it's about 1 million now, so say 400 up. The race view one's like doubled, right? 300 now, 800. So it's actually probably gained more, right? So I would be saying, if it was me, I'd be offloading the townhouse for $1 million. I would then try to pivot into house and land. Doesn't have to be, it can be anywhere really, but has that potential to grow, right? Now, as we know, housing, construction, expensive, we're not building enough homes. Land is king in my opinion. I've got a client who bought 3 years ago for 1,000 square meter block for around 1.4 mil. Today, 3 years later, it got valued at 2.5.
Yeah.
So it made $1 million in 3 years. Like, I was just like gobsmacked, right? Because of that land component. With the townhouse, you can't really knock that over and start all over again, right? Whereas this one, old house, doesn't matter, but it's on 1,000 square meter block. can subdivide. There's that potential to do more to it. If that area gets rezoned R3 or something like that, you're now looking at like 3-story apartments or something, right? So that's what I'd probably do. I think the key to the growth is the assets itself as well. So you got few options to look at, right? Serviceability is a wall. We can use non-bank lenders to pull out that equity, or we can look at maybe offloading something to get maybe into a different asset that might have that further growth for you.
No, that's fantastic. Now, Danny, did you have any questions for Son before we wrap up this part of the podcast?
No, I mean, I everything that you've shared and the advice that you've given has been fantastic. I know that I can explore more in the sort of the finance space and explore opportunities there. And I know that there's opportunities to review my current portfolio as well and sort of tinker with things, rejig things to, keep that trajectory moving forward. So look, at the end of the day, I'm just a battler from Western Sydney having a solid crack at this investing game, and the
You're doing well,
information
mate.
and the learning that I get along the way is all appreciated and helpful. So I just want to say thanks.
Thanks, Danny. And some of the that return on the race for you place is absolutely fantastic. Amazing, yeah. So congratulations. And that was self-found as well. So it shows well done, that looking for that data, looking for the right checklist, and just in a second we'll be talking about our own finance checklist. But that's what you got to do. You got to do the research and you got to put in those hard yards. So thank you so much, Danny. Unpacking a finance-ready checklist for our listeners who can apply this week. Take us through that.
Okay, so as a broker, when we look at our client's position, are they ready to go? First thing is, what income do they have to use across themselves / the group? Then we look at their debt position. Then we look at their credit file, right? So all the listeners out there, make sure your credit file is good because you could be earning heaps of money, really strong equity position, but then you've got this little smear on your credit file, like you miss one payment. Right.
So that's all it takes.
All it takes, right? And then the lenders, there are lenders that will do it.
Yeah.
But like if you're in this prime position for a really good rate, solid deal, something little like that can hold you back. I had one deal recently that was exactly like that, right? And it was over a 24-month period. It was literally just a credit card. They didn't use it, and then they had the annual fee. And they're oblivious because they don't use the card.
So they didn't check that there was the annual fee owing?
Yeah, and then they received the overdue notice. Oh, yeah, cool, I'll pay it. But that actually hindered it because this particular lender had great rates. As I said, the lower the rates, the tougher the criteria. Because of that one blemish, I got it through at the end of the day. I got the exception because I really had to fight for it. But, the reason why they're so tough because they look at data. The bank's got all this data and they said, all the reporting that we've got for a borrower that's got one blemish on like a credit card, they do go into default arrears, right? Yeah. On their home loan repayment. So it was a big deal, right? So we fought it because we said, look, they don't use this credit card. It was literally an oversight and they paid it straight away. And look at their income serviceability position, earning stacks of money. So they looked at it and made sense. So they did it in this case. I said, don't put my client in the same category as the rest of your clients that have a blemish and then have a default, right? Because they're probably defaulting on the credit card because they can't pay it. So that makes sense. But my guy's not using his credit card.
It's a mistake.
It's a mistake.
Yeah.
He's got big cash position as well. So it's just, that makes absolute sense. Things like that can really make a difference.
Can I just jump on that for a second? Because it's something, there's a bigger piece to unpack here as well, which is, partnering with a good broker. When it was only probably 10, 15 years ago and you had the broker channel versus the director bank. And I think a lot of our listeners on SBI was our partners, they were podcasting about this 15 years ago. A lot of our listeners would have been in the investing game for a very, very long time and would remember that the broker channel versus the director bank argument, I think it's like now 77% of people go through a broker. Yep. The director bank's kind of over. But what a lot of investors still don't understand is just how pivotal a broker is, which is there's a broker that, not to be disparaging to some, but when you've got the kind of 22-year-old and you go to maybe a franchise and maybe they don't know much about investing or buying property themselves, but it's their kind of first post-uni job. and they will go through the automated CRM processes, and that's one type of broker. Versus you've got brokers like yourself who are you're in your client's corner, and you do that business development with the banks, and you do that business development with the non-bank lenders. So you've got that in to say, hey, I've got this client here that, mate, it was a mistake. Like, look at his position. He could easily pay that $150. Like, that's not a problem for him. Don't hold it against him. And there's a difference between a good broker who will go into fight for their client versus the broker that you walk into your local franchise office who's 22. Again, not to be disparaging, but it's a different type of service.
It is.
That is something that I think a lot of investors don't put enough stock into, which is picking the right broker for them.
100%. Like, we get it all the time. Clients come through, it's just like, oh, my broker says I'm tapped out. Go, really? Who are you using? And they tell me and I just laugh.
Yeah.
Why are you laughing? And then I tell them exactly what I told the viewers today. It's all about policy. They don't know their policies. They don't know their lenders. When I have brokers come to interview to come work for myself, I always ask those questions. Who are you using? Why? I really delve into the policy. What's the policy on that? Well, do you know it? And they don't know it, right? A lot of them just plug it into a calculator and go, oh, I tried it with CBA, it didn't work. Yeah. And then what'd you do next? Oh, I tried ANZ, I tried Westpac. Mate, they're all the bloody same because you don't know policy. When I speak to my client, I suss out everything that I need to know. So if you say to me, oh, I get a lot of commission. I go, right, a bank's going to shade that. Or you might go, oh, I only got 1 year bonus. Most lenders want 2 years. I know a lender will do 1 year. So I'm already calculating in my head like who I'm going to take you to.
You're narrowing it down.
I'm narrowing it down, right? So I'm just asking more and more questions to really understand your position, right? But it's true. I think that checklist as well, find yourself a good broker.
Yeah.
Right? Who can navigate. This credit card deal I had with one exception, I actually had another exception because this particular lender only took 4 properties in the one trust. I had 6, so I really workshopped the hell out of it, and credit state manager, everyone, gave me the green light, got the approval. My BDM calls me Mr. Exception now. So even she'd never have seen that. Yeah. So I fight for my client. I fight for the deal when I'm confident that, mate, you shouldn't even be questioning this deal. You should just give it the green light because it was so good.
Yeah. And I do see it all the time of people getting hamstrung by bad brokers or bad advice or brokers that aren't there for a long-term partnership, long-term journey. And I cannot stress this enough. There are going to be brokers that are happy to tick and flick. And some brokers are going to try and push you right to your limit, push you to 100% of your serviceability on one deal because they don't expect you'll be back, which will stop your property investing journey or set it back 10 years unless you bought in some amazing growth location and you sell it in 2 or 3 years and you've got a bunch of money. It's going to set you back. And that's where you need your broker to think strategically. Say, hey, if you want to go on this investing journey, your serviceability after this, we're not looking at the next purchase. We're looking at the purchase 2, 3, 4 down the line to say, oh, if you buy this, you're not going to have purchase 2, 3, 4. You want your broker to be with you on the long term, to think for the long term
planning.
And that's something that I see all the time that people in the investment industry or investors don't do right. What else do we have on our checklist for our listeners?
What else do we have on checklist? Going back to speak to the accountant, getting advice on, should we look at structures? I'd say from a lending perspective, definitely. If you are looking to push that boundary, we need to be looking at that sort of structure. If you're self-employed, make sure, your taxes are all done. Biggest thing with self-employed people, they do not do their taxes. But we do have things like a low doc, right? Again, interest rates are high, but it doesn't matter. Again, don't focus on interest rate. If you want to get in, you can do it.
And the low doc, I've actually heard this a fair few times really over the last 6 months. Can you take us through it?
So low doc just means it's a different form of verification with income. So being self-employed, you have to provide company financials, tax returns, individuals, etc. Now, business people, mate, sometimes they can't get their tax returns done in a timely manner. They're busy running their business. They've got entities galore. It takes time to do this tax return. And the window to do it is very short, let's say, right, from the bank. So, utilizing a low doc lender is great because you've got 3 forms usually. One is an accountant's letter. The accountant who's done your taxes can basically sign off to say, yes, I'm comfortable that this person earns X amount because they're the accountant. They know historically you could afford it essentially. Then you've got maybe a BAS position where you can look at some BAS statements for the quarter for ×4 for the year. Or you can look at business bank statements. They just see what's coming in, what's going out, and they have a rough position on it based on your industry code, we call it. So that's low doc, right? But again, do it, get higher interest rate, and then in time when you've done your tax returns, you want to get that lower interest rate, you can always refinance it back. The other one is ATO portals for self-employed people. Just make sure your portals are clean, clear, no tax obligations. Because banks will crucify you for that. A lot of people say, my accountant tells me to not pay it because it's low interest rate, etc. Yeah, I get it, blah, blah, blah. But, the reason why banks want you to pay it off is because when you become bankrupt, the government, the ATO gets first dibs. Right. They get first dibs. So that's why they want that ATO debt's clear.
Interesting.
Yeah.
Yeah,
So,
I did not know that.
I did not know that a long time ago until I found out.
Yeah.
But yeah, so that's because you're okay with certain debts, blah, blah, blah.
Yeah.
But this one is like a hard no, must be clear.
Yeah.
So, you dig, you ask, curious, and that's what they tell you. Wow, okay. Makes a lot of sense. So the ATO want their money.
Yeah.
So so the banks are, all right, we'll do the deal, just clear it, and then away you go.
Interesting. I'm not surprised.
Yeah.
Yeah, I'm not surprised.
Yeah.
Now, going on equity and valuation strategy, can you take us through this?
So valuation is the interesting one because a lot of banks have different valuations and depending on who you use. So it's really interesting at the moment because we do what we do. We're noticing certain lenders have a high valuation.
Yeah, they do.
Yeah. So, but it rotates. But the funny thing is,
well, for our listeners, can you take us through that?
Okay. So as in, I don't want to name the lenders.
Yeah. Okay.
Right?
Yeah. Well, Bank A, maybe.
Bank A. So let's say, for example, I've gone to Bank A because the interest rates are great, whatever. Client's strong serviceability, so we want to get them the best rate, right? We're not stuck by servicing, so I'll go to this lender. But we did a valuation, desktop came back woeful. Well, not in line with expectation.
Yeah. So
one, we can go, right, let's order a full val, get someone out there and just see what they say. Or do we just go to another lender and that's similar to where you currently are in terms of what we're proposing in terms of interest rate and everything like that, equity release, and see what their val is. And then their val's, it's 200K more or something, which is very odd for a desktop because desktop's meant to be the same, right? Core logic, whatever. But yeah, again, if let's say, for example, out of the 4 banks, we go to Bank C because it's got the highest valuation, then we could propose that because your serviceability is still good. Okay, the interest rate is slightly higher, but they're in range. Let's go to Bank C because then you're going to extract as much equity as possible. You're still going to be able to service it based on their parameters. Interest rates like high, who cares? But we can do it. So as a broker, we look at everything. The borrowing position, the interest rate, try to kind of get a balance of everything. And the interesting thing is, even if you did a full val with Bank A and it was with, I don't know, Heron Todd White or something like that, you can go to Bank C and they would take that.
Yeah.
You just go, can you use this one? Sure. We just get it reassigned because it's on the panel. Away you go.
Yeah.
Fantastic.
And it is very pronounced and some banks are more likely to over than others. I had it with my PPOR and I was so shocked. We got multiple, and some of the variation was insanely big, and that's something on both sides in terms of investor strategy. Don't go off some random val that you see online. I'm going to guess a lot of our listeners they might have their own core logic or RP data logins that they might have to track comparables in the area, and it gives you the kind of suburb median or the estimated price. Don't go from it because. Not to say that sometimes it's low, sometimes it's way lower, but when it's a lot higher as well, there is an inherent risk that you are overvaluing your position. Now that's fine if you're looking to do an equity release, if you're cognizant of it. If you're if you look at your place, you're like, or you look at your investment property, like, I think that might be a bit high, but I acknowledge that I'm still going to do the equity release because I'm more risk seeking, and that is in with your own investor profile. But don't take it for gospel. And I think that's a very important thing.
And another point on that is like, to increase the values, we see a lot of renovations being taking place, etc. Improvements to the home. That can definitely significantly increase your value, because construction costs at the moment are quite high. So people that have spent the money to do the reno, really nice house, people will pay more for it. It will be valued higher. So, we ask people, and it's, have you made any improvements? And you can tell you yes or no, etc. So then we decide on whether we do push it for a full val, etc. But if we're happy with the desktop, we just play on. Yeah. But because going to a full val doesn't necessarily always mean that you're going to get a higher value. I've seen it come back worse.
Yes, yeah.
And if it's worse, too bad. You've got to take that, right? Yeah. But in this environment where property prices are growing so rapidly at the moment, we're pushing for those full vals.
And there's a lag. There's a lag. I've seen it on RP data where there's a number of comparables in an area where I saw it go significantly higher, and it's still kind of stuck like 6 months ago in some of the data. It's like, that is not the price that it is now, but it is always good to be aware of. Now, we've unpacked one of Danny's main points was he wanted to reduce his time on the sidelines. And we unpacked one of those options, which is actually deciding to sell. And I think one big change, even in conversation with a lot of investors that I've noticed, is a changing mindset. I think property investing 15, 20 years ago was maybe more out of reach for a lot of us, or less, maybe more exotic. It was less known for a lot of Australians because it'd be like you'd be around a barbecue and say, oh, my uncle owns a place in Brisbane, or I know this person that owns a place there. Now with access to podcasts like this and to experts and being able to read online the strategies, it's becoming a lot more closer to home to a lot of people. And with that has been, in my opinion, a bit of a change in strategy, whereas 15, 20 years ago, not everyone, there was a more tendency for that buy and hold. Now there is more of a willingness for that buy, hold, sell. And people are willing to realise the growth in equity more so than they were before. Tell me if you disagree, but for our listeners looking at Danny's situation, but more broadly as well, don't rule out selling.
Look, never rule out anything really. Always have an open mind. I'll give you an example, like everything we do with our clients that comes to us, they tell us what they want to do, and I'll go, right, this is what, and we'll do it, try to do it anyway. But what I like to do is everything we do is always equity release if we can. Because the way I look at it is when you've got that money ready, 500 grand, right? You can use that for any opportunity that comes knocking on your door. Yeah. And when an opportunity comes knocking, you got to be ready to pounce. It could be residential, could be commercial, could be buying a business, could be investing in shares. When it's time and you're not ready, you have to quickly go and refinance your home or get the equity out. And at that point in time, property prices might have come down. You might not be working. You've had a baby. Who knows, right? So what I say is if you can do it now, do it. Get the money ready. Look at a property, etc. Don't let interest rates scare you off. If you can get a good broker who can get you that money, get you that property, and it is a good property, it's a good asset, do it. Because in the market, what we see is over time, I hear it all the time. Oh, property's expensive. It sure is when you buy it. But then 3 years later, you think, mate, that was a bargain.
100%. Yeah.
That was a bargain.
Yeah. That's a fantastic way of looking at it.
Yeah. So, you just got to be in it. You just got to do it. And if you can do it, get in. I would just stress to everyone out there that speak to the right people and just do it.
Thank you so much for joining us for episode 3 of Inside Residential Property. Now, if you enjoyed the episode, make sure you head to our YouTube channel or Spotify or anywhere that you get your podcasts and hit subscribe. And make sure that you're sharing this podcast with any friends, family, or potential investors to help them chart their course for financial freedom.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.